What if I told you the most successful investors in America aren't the ones who know the most? They're the ones who decided the least. There's a system that quietly built more wealth for more ordinary Americans than any stock pick, any crypto bet, any hot fund recommendation ever did. It's not exciting. It's not complicated. And that's exactly why it works. By the end of this video, you're going to understand the single most powerful thing a beginner can do with their money. Not someday, starting this week. Let's talk about why most people never start investing. And it's not what you think. It's not lack of money. Plenty of people with very little have started and built real wealth. It's not lack of information. There has never been more free financial education available in history. It's something else entirely. It's the feeling that you need to be ready, that you need to understand enough. That investing is for people who know how to read earnings reports and track sector rotations and time the market. Here's what the data actually shows. The average actively managed fund, run by professionals who do this full-time, underperforms a simple index fund roughly 80% of the time over 10 years. Let that sit for a second. The experts lose to the index most of the time, across most years. So what is an index fund? At its simplest, it's a basket that holds a tiny piece of hundreds of companies at once. When you buy into an index fund tracking the S&P 500, you're buying a sliver of 500 of the largest companies in America. Apple, Microsoft, Amazon, hundreds more, all at once. For the cost of a single share, you don't pick winners. You own the entire game. When the market goes up, your investment goes up. When individual companies fail, the others carry the index. You're not betting on any single horse. You're betting on the race continuing. And here's the thing about that bet. Over every 30-year window in American market history, the S&P 500 has been positive. Every one, not every year. Some years are brutal, but every 30-year window, it's positive. Now, the system isn't just owning an index fund. Anyone can do that once. The system is what you do after you buy it. And most people get this part wrong by doing too much. The move that actually builds wealth is called dollar cost averaging. And it sounds almost insultingly simple. You invest a fixed amount at regular intervals, regardless of what the market is doing. Every payday, automatically, without looking, without deciding, without reacting. Here's why this works when stock picking doesn't. When you invest automatically every 2 weeks, you buy more shares when prices are low, and fewer shares when prices are high. Over time, this averages out to a lower cost per share than if you had tried to time the market. The person who panicked in March of 2020 and sold everything, locked in losses and missed one of the fastest recoveries in market history. The person on automatic contributions never made a decision and quietly bought shares at the bottom without even realizing it. Think about it. You don't make a decision about whether to buy groceries every week. You just go. The automatic investor treats the S&P 500 the same way. Now, let's put a real number on this. A 30-year-old who puts $200 a month into a low-cost S&P 500 index fund and leaves it alone reaches age 65 with roughly $350,000 at historical average returns. $200 a month. The cost of a streaming subscription and 2 restaurant meals. Gone automatically. And you never think about it again. That's not a projection from a sales brochure. That's the math of compounding applied to the most boring investing strategy in the world. But here's the question that trips most beginners up. Where do you actually put it? If your employer offers a 401k with a match, that is your first stop, every time. Without debate, an employer match is a 100% return on the matched portion before your investment does anything. If they match 50 cents on every dollar up to 6% of your salary, and you're not contributing at least 6%, you are leaving a raise on the table. Literally, every payday. After the match is captured, the next stop for most Americans is a Roth IRA. You contribute after tax dollars today. your investments grow completely tax-free. And in retirement, you pay zero taxes on withdrawals. For 2026, the contribution limit is $7,000 per year if you're under 50. Both accounts allow you to hold index funds inside them. That's the combination. The tax shelter of the account and the simplicity of the index fund. That's the system. 401k to the match. Roth IRA maxed if possible. Low-cost index fund inside both. Automatic contributions every payday. And then you leave it alone. No watching, no reacting, no switching. The enemy of this system is not a bad market. The enemy is the investor who can't stop watching. There's a study from Fidelity that's become something of a legend in personal finance circles. They analyzed which of their investors had the best returns over a long period. And the answer they found was somewhere between uncomfortable and hilarious. The best performing accounts belonged to investors who had forgotten they had an account, or who had died. The investors who never logged in, who never made adjustments, who never reacted to a crash or a rally. They outperformed the active ones because they never interfered. Now, I'm not suggesting you forget your retirement account exists. I'm suggesting something close to it. Set the system. Automate the contributions. Choose a simple index fund. And then resist every urge to do more. Your job, as a beginning investor, is to be boring, reliably, consistently. Without exception, the financial media is designed to make you feel like something needs your attention. That there's always a move to make, a risk to manage, an opportunity to chase. That noise exists to generate clicks. It is not investment advice. It is the enemy of your returns. The market will go down, probably more than once while you're reading this. Your job in those moments is not to act. It's to add to your automatic contributions if you can, and otherwise, to do nothing. Here's what this system gives you that no hot stock tip ever will. It gives you time. Not your time, the market's time. Every year your money stays invested is a year where compounding does its quiet work. Einstein may or may not have called compound interest the eighth wonder of the world. But the math is hard to argue with. Money that grows on top of last year's growth, on top of the year before's growth, becomes something unrecognizable over decades. Something that feels almost unfair by the time you reach it. It gives you certainty, not certainty about returns. Nobody has that. Certainty about your behavior. The system removes the decisions, and the decisions are where beginners lose money. And it gives you something most investment strategies don't: permission to live your actual life. The system runs. You don't have to babysit it. There are people in America right now sitting on $400,000 portfolios who started with $200 a month in their 30s, who never picked a stock, who never timed the market, who never understood what a price-to-earnings ratio means. They just started. They automated it, and they got bored. If this is the beginning of how you think about investing, subscribe. Because next week we're going back to the psychology, the exact mindset that makes someone actually follow through on a system like this or quietly sabotage it.